Hi, I'm John Vance, founder and CEO of Vance Wealth. We are a financial planning firm with deep expertise in a client care philosophy and serving families and business owners. And I have been giving these annual market update workshops for over 20 years. This content is part of the favorite my favorite event that we do, primarily because we get to cover what happened in the prior year and what are we looking forward to ahead. And when we're meeting with our clients, especially as we do our annual review season, which is coming up pretty much from like February through June, we like to focus on our clients' financial goals, helping them make progress on what's important to them. But we also recognize a lot of the market information, a lot of the economic information is important to them. So that's why we created this venue and this avenue for me to share. So we do have a lot to cover today, and I'm really excited. Before we jump into the exciting data of the markets and the economy, I do just want to give you some Vance Wealth updates. And so one of the things is as a firm, we're very much committed to continuous growth. And what that means for us is the ability to serve more clients, to take care of a growing team and really build amazing careers for our people. And then additionally, making an impact on the community. So those are things that are really important to our company. We made some really great investments this past year. We added Nikki, who's our director of coaching for our advisors, Bronson, who's our tax specialist as an advisor. And then we have two new planning associates that were interns this past year, and we've offered them full-time jobs. Lucas has started, I should say, as of January. And Sierra will be starting in May once she graduates from Cal State Northridge. Additionally, some exciting news. I think many of you know we as a firm have been diligent about making sure that we have a long-term succession plan in place so that we as a firm can continue to serve you, continue to serve your families, forever, I guess, right? So we are proud to announce that we have three new partners. This was done in 2025. Chris Pelch, Jared Ferguson, and Tyler Tilton, three amazing people that have been part of the team. Jared for 17 years, and Tyler and Chris for around eight or 9 years. So it's a really exciting year. And then additionally, we expanded and opened an office in the Costa Mesa area, which is really going to serve Costa Mesa, Newport. So some exciting updates. And one of the reasons why we continue to add these amazing team members, a lot of it's in thanks to you. We've received quite a bit of referrals. That's how our business grows, is word of mouth. So we're committed to continuing to do amazing work and to continue to serve you. So please let us know how we can improve, how we can make an impact, and don't keep us a secret. We're always here to help and help anyone that's important to you. So without further ado, we're going to jump into some of the slides we have today. We have a lot of different topics we're going to cover. And I hope you find this valuable. One of the things I do want to make a call to action for you is if there's things that we did not cover throughout this year, I'm committed to doing more topical content just around economic issues, market issues, things that are coming up. And so like last year, we did one on the new tax bill that was passed. And so if you have thoughts or ideas of other topics you would love us to do a deeper dive on, I'd be happy to work with the team to generate some additional content. All right, so as we build out our cadence for this presentation today and this conversation that we're going to have is number one, we're going to focus on just looking in the rearview mirror, what happened last year, and then we're going to look ahead and try to highlight areas that we might have concerns with, areas where we're highly optimistic. And that all starts though with let's look in the past. Let's look at how things played out. So by all measures, 2025 was a great year from a investment perspective. There's a lot of data on this chart, but if you work from left to right, the US stock market was up over 17%. International developed stocks were up over 31. Emerging market stocks up over 33. Real estate had a mediocre year, I would say. The U.S. bond market had a great year, up 7.3%. And as we all know, there's a lot of other factors that go into these types of returns. But by any measure, this was an excellent year, and one that I think we all wish we could have every year. But the reality is we know there's ups and downs with the markets. But we get to look back at 2025 with a smile, with knowing that we had an excellent year from a market perspective. One of the things, though, that I did want to highlight is 2025 really got off to a rocky start. And, now that we're looking back and we can see all those positive numbers, I think we forget how rough it was early in the year. So, what this chart shows is from basically January 1st of last year through April 8th, which would have represented the low in the market for the year, primarily driven on or primarily based on tariff concerns. You can see how painful this was. And so we're looking at four indexes, which would be the S&P represented by purple, the Russell 1000 growth, which is in an orange color, which represents a lot of the technology companies, the Russell 2000, which is small companies, and then the green, which represents international. So what you can see is international held up great, only down 3% through that low, but the S&P was down 15, and the other two indices were down over 20. So one of the things that's really important when we're looking at that is now that we can look back with hindsight being a guide, and we can really feel good about last year. But man, in April, we had some tough conversations with clients, about maintaining discipline and maintaining your investment strategy long term, even in light of all the chaos that was occurring. And it paid off. And we think over time as investors, that will continue to pay off, even through uncertainty, which we know is not going away anytime soon. And so I do want this to just be a learning lesson for everyone, is that how important it is to have discipline around decision making and not allow these news events to scare us out of making good long-term decisions. That's what we're here for at Vance Wealth, helping add discipline to the decision making, helping to avoid the noise, and a lot of times really assist with making good decisions in times when it's difficult to stand pat and oftentimes actually commit more capital to your investments. So what we're going to now go through is just at a high level. I should say we're going to go into the weeds a little bit more on looking at each part of the market. So the U.S. stocks. In the bottom left corner, you can see that the U.S. stock market represents about 63% of the overall global markets. We maintain at Vance Wealth a very diversified strategy. We are globally diversified. Our portfolios tend to be around 70 to 75% in US stocks when we look at the whole picture. And so if you notice, the US stock market makes up about 63. So we do have a slight overweight to the US, which makes a lot of sense because we live here in the US and we spend US dollars. And so we do believe that that does make sense. But I just wanted to provide a little bit of that perspective for you. One of the things that happened last year was growth continued to outperform, large caps continued to outperform, and that was only on the US side. As we look at international, the international markets had a great year. There's a lot of data on this chart. If you look at the top right-hand corner, you'll see where it says ranked returns. And there's two bar charts that we're looking at there that says local currency and US currency. So when we invest in international investments, for the most part, we are investing in U.S. currency. So that means that those are the returns that our investors get based on the fact that we live in the U.S. and our investments are made in U.S. currency. And so you can see, that middle the middle return there. It says market wide. So in U.S. currency, the market wide international developed was up about 32%. Where just in local currencies, it was only up 22. So we definitely had a tailwind from a weak dollar last year, and that also occurred in emerging markets. So emerging markets was the strongest of all of the markets around the world, and representing north of a 30% gain as well. And so value outperformed growth, small company stocks outperformed large cap. So a lot of our philosophy on how we build portfolios for clients, it really paid off this year because international did well, emerging markets did well, and then also value and small caps on the international investments did extremely well. Real estate got a little bit left behind. U.S. real estate is represented by REITs, only up about 3%. Global real estate, global REITs did quite well, up over 24%. And then here, domestically, looking at the housing market was very sluggish, with home prices not really doing a whole lot. And we do think that as interest rates come down, that'll start to change. But 2025 was not a great year for real estate. Probably the most exciting, at least headlines, I would say, for this past year is looking at some of these commodity prices. So what we're looking at on the right-hand side shows a full list of commodities. It shows what their returns were for 2025. And the two that jump out, and this should not be a surprise to any of you, is the fact that silver was up over 150%, gold was up over 57, and that, I mean, it's pretty remarkable to see those gains, and we're seeing that in the new year where those returns are getting stronger and stronger. And then you can see copper's done really well, obviously with all the build out that we're seeing in the infrastructure with building out AI. And so that has been a buzz that I've seen. I do think as we get into this year, I will dedicate another educational conversation around silver and gold and should they be a part of the portfolio. Right now, it's really popular, but if we look back historically, they're not great long-term investments, but they have proven to be a pretty good investment here in the near term. One of the things that I did highlight on this slide is if you look at on the bottom left, it shows periodic returns for commodities as a basket, right? Looking at all commodities. And if you notice last year, one year, the basket of commodities was up about 15%, driven by some of these metrics that we see on the right. But if you look at the last 15 and 20, returns for commodities are down 1% on a 15-year and basically down a 0.5% on a 20-year. So it shows that relative to investing in stocks and things over time that would tend to grow, that commodities historically can be tough long-term assets to own. And one of the noisiest charts that we have here, which just represents different asset class returns going back and looking at the last 15 years, really set up as this like periodical chart. And what you'll see, just different colors throughout, this represents real estate, small company stocks, emerging markets. And so the returns last year, 2025, are on the far right-hand side, and it shows you that emerging markets led. We just covered that. Large company stocks did well. Commodities had a good year. Real estate was not. Cash was very mediocre. But what actually goes through this entire chart is what's called asset allocation. So being diversified, and it shows us that it's never at the top nor the bottom, but asset allocation was definitely a winner last year. And that's an important part of being an investor is make sure we diversify. And everyone has different diversification, but again, it's really important to make sure that we have broad diversification because it helps our clients and helps us as investors achieve our long-term financial goals. All right, so now we're going to just pivot as a reminder, and I want to unpack our approach to investment management. Most of how we approach things is very, I would say, by the book, industry best, looking at institutional approaches. We've made it more of our own from an institutional perspective, but we truly embrace this idea of managing money in an institutional, well balanced, diversified approach. And I do want to highlight really our key four areas there. And I do think it's important that we share our core tenets of what we focus on. So number one, the market, focus on the long term. Too often we get caught up in a lot of the short-term noise, and it's really hard to be a successful investor if you're betting on short-term decision making. We just believe that you can be the most successful by having a long-term approach because we feel like markets are more predictable over time and they're highly unpredictable in the short term. So that's number one. Number two, asset allocation. Focus on what you can control. So looking at what you can control, for most of our clients, it's looking at spending needs. What is it that, especially if you're retired, what is that you're going to need this money for? Building your allocation to support that. If you're still working, making sure you have enough reserves in case something goes wrong, making sure you have capital, or if a financial goal pops up on the horizon, making sure you have some safer assets. And so again, it comes down to understanding your spending needs and building your allocation to support it. It's also really important to assess your ability to emotionally handle the market. And also when we look at asset allocation, rebalance your portfolio with a purpose. And so that fits under this bucket of focus on what you can control. Number three, utilize diversified investments. We've already made the case as we started this conversation today, the benefit of being globally diversified between US and international stocks and adding a mix of fixed income as well to the portfolio. That's highly important to be successful over time. And then the fourth key point for how we manage money at Vance Wealth is focus on low fees, low turnover, and a consistent process, and really a disciplined process. And so those are the four key tenets that we make all of our decisions. And we've had a ton of success, and we do have the expertise in this area. And this is, I think, why many people hire Vance Wealth, because they know we're going to bring this to the table. As we illuminate the asset allocation strategy conversation, this is a nice graphical way of seeing how we approach this. And so we do look at, for clients that might need money in the next 0 to 2 years, those should really be invested in some sort of cash equivalent type of investments. When we then look out a little bit beyond and say, okay, well, how much are they going to need maybe in years 3 through 7? Then we go into fixed income, which would be primarily bonds. And then we look at the long term, which is anything beyond 7 years, which would be in growth assets. So the way I would look at this is if you are working currently, your fixed income bucket in the middle is probably not as necessary. A lot of our clients who are currently working and don't plan on retiring in the next 5 to 7 years, they have some cash reserves and then they have primarily growth assets. This strategy really makes the most sense, and hopefully creates a nice visual of when you're retired, how do we look at managing risk? How do we look at if the markets have a bad year, how do we plan for that ahead of time? And so that's why we build it this way, because we definitely want to have our long-term assets go into growth investments, which would be primarily stocks and real estate. And that's how we approach is number one, based on spending, based on your cash flow needs. Number two is also risk assessment. It's important to understand what is your tolerance for investment loss and volatility. We all have a different tolerance level for that. So understanding those two components are really what drive that asset allocation strategy. I will tell you that I believe that is unique to our firm because most firms flip that. They start with a risk assessment and then spending, and we've turned that upside down because we think it's far more impactful and it'll allow us to build an allocation that's more in line with their long-term spending goals. And we do believe over time that'll help with results. And then we have a rebalancing discipline. So rebalancing basically just means we know we're going to have assets that are not going to move in tandem. They're going to be all assets have different types of returns, strong years, mediocre years, lost years. We really look at the fact that we know as we build a portfolio that's well diversified, we will have assets that do not move in the same direction. And that is by design. So when we go through the course of a year or multiple years, as we have these ebbs and flows in the markets, we have a very disciplined approach to how we rebalance accounts. And frankly, that is one of the things that we're seeing right now is that a lot of clients are, I should say, prospective clients that are coming in the door. We see a lot of portfolio concentration. Portfolios haven't been rebalancing. Their portfolios, I would say, are very much looking in the rearview mirror, meaning they own a lot of what did really well over the last 10 years, and they're not addressing what might do well in the next 10. And so that just shows us there's not a disciplined rebalancing approach. And we do think that's pretty critically important. So one of the things that I would make an offer is that if you're on this and you're a prospective client and you don't feel like you've looked at the portfolio to really establish the asset allocation and really evaluate your overall diversification, we're here to help. Let us take a look at that, and then we can help put some discipline in the decision-making process on a go-forward basis. Oops. Okay. Our next topic is dealing with the psychology of money. So markets and psychology, climbing a wall of worry. So that's definitely an expression that Wall Street uses. The simple fact that when you, as an investor, when times feel amazing and good, then usually that means there's market tops. And when there's a lot of bad news and everyone's worried, there's always some headline about, what can go wrong. That's this whole narrative around climbing a wall of worry. And I think we can all agree right now there's a ton of worry out there. And so the markets are essentially in this sweet spot, we believe, because there's a lot of healthy, what I would call skepticism and pessimism out there. So this is the psychological wave that markets tend to go through. Now, we do have to admit they're not always going to be this uniform. It's not perfect, certainly. But if you think through, if we let's start on the far hand left side. So we go through this wave in the markets where you get optimism and excitement and thrill and then euphoria. Well, when you have this euphoric environment, that means we're essentially at this point of maximum financial risk, right? Because everyone is so excited, they're convinced that it, can't go down, all things are amazing. That's the euphoric type of markets. We don't want that because that means prices are high, and that also might be a setup for, a future decline. As we go down this curve, we can see the denial, anxiety, fear, depression, panic, capitulation, and despondency, right? That's all of the things that happen in a bear market as we start coming from a top to a bottom. So as we're looking at this, I think we might all have different opinions as to where we are, but I would argue that I feel like on the right-hand side is where we're living today. We're somewhere in this skepticism, maybe even hope environment. I certainly don't think we've reached full optimism. I think to the person, I'm very optimistic, but I think as a society and when we see what's happening with media and just general feelings that are out there, we're in the skepticism side. So what this would tell me is, as we look at historical trends with the markets, is that we still have room for the upside for the markets to continue to move higher. And that is the premise we're working under, is that there's a lot of cash on the sideline. And over time, as investors get more confident, that money finds the markets, that generally drives prices higher. And that's really the viewpoint that we have on a go-forward basis. Now, I don't think any of us can probably read this one because there's a lot of noise on here. But what this chart is designed to show us is that markets have rewarded discipline. What I mean by that is these are all the headlines throughout just this year. And you can see the bottom of this chart that showed up in April, which was through all the Trump tariff conversations and how that was going to impact China and the rest of the world. And then how resilient the markets were for this year, and looking at the global markets returned over 20%. And so what this just shows is that drowning out the noise, focus on the long term really won. This is a great example of that year. And this is just designed to highlight that. And you can see there's always a lot of bad news that's built into economic data. And I think that the disciplined investor is the one who did extremely well last year. All right, so the next topic we're going to jump into is embracing volatility. So the reality is that in order to be a successful investor, you have to embrace volatility. There is no other way to be a stock investor, an investor in great companies, an investor in real estate without embracing volatility. The simple fact that there will be ups and downs on a day-to-day basis, and it's really important to not look at volatility as a negative thing, is embracing it, is knowing it will happen. The severity of it, we don't know. The duration of it, we don't know. But I think embracing it is really a much more of a powerful emotion. Embrace it, deal with it, because that allows us to be more disciplined. When we don't embrace it, I think we take the approach that volatility is happening to us without recognizing that volatility is very normal. And any of you have attended a market update. We show this chart. I think I've showed this chart every year for at least the last 10 years. And it's a pretty simple chart, even though it looks extremely noisy. So what this says is the S&P 500 intra-year declines versus calendar year returns. So if you think about that, what does that mean? So we know markets are volatile throughout the year. So intra-year decline. So when the markets go down during the middle of the year, like last year with tariffs, and then what's the calendar year return, meaning what happened for the whole year? And the subheadline on here says, despite average intra-year drops of 14.2%, annual returns were positive 35 of 46 years. So the lesson here is that on average, we can expect an inter-year decline of 14%, but that essentially 75% of the time, the market is still positive. So that's the embrace volatility message. And if you look at the far right-hand side, if you can see this, it shows that last year the broad markets were up 16%, which is represented by the gray bar chart. And then if you look just below that, you can see a red dot that says minus 19%. What that is representing is during the tariff sell-off, what the markets actually went down during that period of time. So that's what this is designed to do, is really represent the fact that volatility is normal. This goes back to 1980. This will continue. This chart will look different, but the message will be the same on a go-forward basis. This I found to be quite an interesting slide. So this just represents the S&P 500 stocks and what it's designed to do. And we're looking back at about a 15-year period. And it's designed to show, looking at these stocks, what percentage drawdown was normal. So as we go from left to right, a 30% drawdown in the basket of stocks, a 40% drawdown, a 50%, 60, 70, and 80%. So the far right-hand side shows, how common is an 80% sell-off or drawdown in one individual stock. And then the blue represents a 1 year period, the green represents a 3 year period, and the orange represents a 5 year period. So the message here, if we just start on the far left, is that when we look at the chance of a 30% drawdown in any one company, that over a 5 year period, this happens 72%, or 72% of the companies have a 30% drawdown over that period of time. And then as we go out to a 40% drawdown, that happens 51% of the time. So what this is designed to show you is that volatility is extremely normal, even with healthy names that we all feel great about. And I don't want to list a bunch of names because I don't want to be promoting certain stocks, but we know a lot of the Mag 7, the big companies, and many times we feel like, oh, those can't lose money or they can't go down. And over the last 15 years, we have many times where a lot of these companies sold off 60, 70, and even 80%. So this is just designed to represent that volatility is normal. Embrace it, have discipline. That's my message to you. So what this means for investors, just summarizing. Volatility is normal. Abandoning a plan is not. Number 2, diversifying is about preparing, not predicting. And number 3, discipline matters more than timing. These are 3 core tenets that every investor should live by. This will help them and allow them to be long-term successful investors. And that's the discipline that we help instill on the clients that we work with. All right, one of my favorite topics we jump into is I've had these conversations with clients for the last, say, 10 years, on and off, just different clients. Should I just invest in the S&P? And really what that question is, why would I diversify? Why would I buy international? Why would I buy small company stocks? Why not just buy the S&P? And they're asking that question because the S&P return in this bull market that we're in has been amazing. It's been extremely, the rates of returns have been pushing, double digits. I believe over the last 12 years, we're looking at the S&P compounding it, in the 14 to 15% range. So above historical numbers. And so this conversation has been coming up more and more. And unfortunately, I think what we're seeing that's coming in with prospective clients is that people are abandoning diversification because the S&P has been a popular place to invest based on past performance. And that's one of the things, the whole message of this is trying to make the case of, yes, the S&P is a great place to invest, but it's critical that we diversify it with other asset classes because it's not always the best place to invest. And I'm going to give you a little history on actually the recent past. So the current bull market, and I would start this current bull market began in March of 2013. So we're coming up on 13 years. And what this chart is designed to show you is a bunch of different asset classes. So the purple represents the Russell 1000 growth, which is primarily driven by large company tech stocks. So the Mag 7, a lot of the big names we know from Apple and Amazon and Google and Nvidia and Tesla, right? So and Microsoft. So the index over this period of time, 13 years, is up over 580%. The orange chart just below is the S&P 500, up 470%. So the question around, should I just invest in the S&P? It comes out of because of this chart, because performance has been so spectacular for the last 13 years that I think people are questioning, should I keep diversifying? And of course, the answer is yes, you should. Being globally diversified is extremely important over a long market cycle. During this market cycle, you can see the S&P has been a standout performer. As we look down the chart, one of the reasons why people are getting, I think, a little bit of fatigue around should I stay diversified is that the blue and the green represent Russell 2000 indexes. That represents smaller company U.S. stocks. And then below them is international holdings. And looking at those have averaged in the 150% range, right? So you can see in the same bull market period how different the returns are from the top to the bottom. And that is where this question has been coming up. And it's a normal question to have. And I will tell you that we believe that discipline is really important. And I would also argue that this is the one of the best times to relook at the portfolio, because if you are overweighted S&P or are overweighted in tech, this allows us to potentially start to make some changes to get back into alignment with a more diversified strategy. So now I'm going to show you some recent, I guess the last bear market in the overall markets, and this period of time. So lots going on here. These are the same indexes. This goes back to March 2000 to March 2013. So this is essentially a 14-year period of time, which we believe was the previous bear market cycle. And we really define bear market cycles as when we have a prolonged period where markets essentially don't break out. And the question that it comes down to, should I invest just in the S&P? Look at the chart at the very bottom. So this represents the Russell 1000 growth, which again is very tech driven. Over this period of time, this 13 years, that market lost 22% over 13 years. So again, let me say that again. Let me repeat. If you would have invested in March of 2000, by March of 2013, 14 years later, that investment was down 22%. If you look just above that in the orange is the S&P. So over this same period of time, the S&P is up 29%. That's a total return, which means that if you average that out, it's around a 2% or slightly less return over that period of time. As you start to look above, you can see that the standout performer is small company value stocks, up over 200%. And then you can see international, we're up around 50 to 100, depending on what index you look at. And so this is just designed to show you, over the last bear market and bull market, how during this bear market that was really tough on tech stocks and really tough on the S&P 500, that there were other places that diversification really added tremendous value. Now, when we zoom out on this and say, okay, well, what if I just looked at these two periods together? So this chart represents, and it's even harder to see now that I zoomed out, but this chart represents the same data points, but now over both of these periods of time. So since 2000, we can see the green, which represents small cap value, has been the best performer, albeit has been the toughest asset to own over the last 13 years. And then if you see on here, if you want to pick up where it says the S&P 500, you can see was in second place at about 600% over this period of time. So you can see it's really important to have differing asset classes over time. And so the short answer to the question is, should I own just the S&P 500? And in our humble opinion, the answer is no. We do think that there's a tremendous benefit from being diversified. And well, what does that really mean? And I know I love getting into the weeds, and so this is a way to really explain, well, what does this mean? If you look on the left-hand side of this chart, what does it look like for diversification? So the S&P 500, if you see this box that we're looking at here, is broken up into large, mid, and small. So those are large cap, mid cap, small cap, and then it'll show you companies' value, blend, and growth. And if you look at the very bottom where it says small has a bunch of zeros. So what that basically means is the S&P 500 is a primarily large company index. It has essentially no small cap exposure. When you move to the middle, which represents the Russell 3000, that's a more comprehensive index that includes mid and small companies. So it's adding more small company. And then if you look at the far right, one of our core strategies that we have for clients using an ETF and mutual funds and even a separately managed account is the dimensional core equity portfolio. And you can see it has a higher tilting, a higher weighting in small. So those numbers down there represent percentages. So in the S&P 500, you have 0%. When you look at the Russell 3000 and adding that up, it's around 9%. And you look at the DFA, which is around 19. So that's going to be not, I wouldn't say identical to how all of our portfolios are run, but certainly we'll be tilting more towards the dimensional side of things because we're using them inside of our portfolio. And we do think that's going to be important on a go-forward basis, especially as the S&P and other markets keep hitting all-time highs. We feel like that broad diversification will really pay off. And I thought this was an amazing chart that highlighted the increased concentration with the markets. We talked about being diversified, and look at what's happening currently in the US market. So if you can see on the screen, it says, what is the weight in the largest 20 companies in the S&P 500 and the World Index? And the largest 20 companies right now in the S&P 500 index represents 49%. So it means 20% of the S&P 500, which is 500 companies, 20 of those names, sorry, I think I said 20%. So the largest 20 companies in the S&P represent 49%. So that means 49%, 20 companies, the other 480 companies, 51%. That's a lot of concentration. And you can see since 2013, that number's been going higher. And again, that just tells us is, yeah, we like a lot of these companies, but having that broad diversification is extremely critical. Okay, so now we're going to pivot into, we're heading in, we're in 2026. And we do think, like all years, that we enter these years with a lot of fear and maybe cases of being pessimistic, maybe skeptic, and then looking at optimism, like what can go right, right? And I think human nature, I feel like that we're wired that way, right? We're wired on what's going to go well, what's not going to go well. I think depending on our mindset, we can fall into the trap maybe and go down a wormhole more than some, right? I think if we're naturally tended to be optimistic, we gravitate towards that, and then the opposite is true as well. I would tell you as a firm and myself personally, definitely lean on the side of optimism. Feeling that tomorrow will be better than today. And so for our conversation though, I want to unpack things that we're seeing that that are creating some concern, and then unpacking and finishing up with why we're still optimistic. So 2026 areas of concern. So first and foremost, valuations are stretched. So when we look at the markets, because we keep hitting all-time highs, markets historically values are up in the upper range of price to earnings, which just basically means that markets are more expensive on a historical basis. Now, we would argue that they're more expensive because there's a lot of good earnings growth and companies are doing great things, and it's driving higher valuations. But we do have to recognize when you look at periods where valuations were stretched, and if you look at this chart, the last time we had a peak of this level, you can see going back to 2000, that was at the dot-com bubble peak. We're not quite there yet, but this chart, I think, is where a lot of academics are saying, hey, markets are too expensive, they can't go higher. So we do agree that valuations are stretched. However, the positive side is we do feel that we're going to see earnings growth, which is going to then justify these valuations on a go-forward basis. And I will have to admit, one of the things that's going to be hard for me to do is as I go through the conversations around our areas of concern, just because of my nature, I will pepper in, I guess, a silver lining on each of these slides, because that's just my nature. And I think it's important to understand that there's always two sides to any conversation. Okay, rising unemployment. So one of the things that we know is that unemployment rate has been rising, and this chart does not show, but and I couldn't get the data ready for this, but there's been we're seeing rising unemployment, especially among young people, college grads, and that's a troubling sign. So I don't know how this will get resolved. So I don't know if I have a silver lining here, but there's a lot of data going on the far right-hand side. It just shows that we're seeing an uptick in the unemployment rate, and we do think that's likely going to continue. There's a lot of chatter that this is all AI driven. I don't necessarily believe that's true, but I do think we're seeing productivity gains that are coming out of AI. And so that is partially part of the story. So we do think unemployment is going to become a growing concern, which is also, I guess the silver lining is that if unemployment continues to tick up, that will make the case for why the Federal Reserve should probably cut interest rates. So rising unemployment will signal to the Fed that the economy underlying is not healthy, and we need to push down rates to help stimulate the economy. So I did find a silver lining, which is good. Federal finances. This is probably one. Well, I'm going to try to find a silver lining with anything. I almost just said there was not going to be a silver lining, but I'm going to do my best to find one. Lots of data going on in here, but basically, if you look at On the far left-hand side, it shows total government spending, which is about $7 trillion, and it shows, Medicare, which is the bottom in light blue, Social Security, defense, interest expense, which is becoming concerning. We're now at almost $1 trillion of interest expense, and then other. So our total spending is 7 trillion. On the far right-hand side is our sources of financing. Where does the money come from? Income taxes, social insurance, corporate taxes. Then we had that deficit number. So my opinion is we don't want this number to keep growing. And if we look at the right-hand side, and at the top right shows the federal deficit and net interest payments, and then it looks at federal net debt, right, in terms of percentage of the economy. So these are troubling trends. My hope is, and my silver lining is a few things that we will get spending down by eliminating what we're seeing now, fraud and waste in the system. So systematically cutting back on some of the expenses, just getting rid of the waste and the fraud. That's number one. Number two, I do believe we're going to see an uptick in productivity and growth. And a lot of times we can grow our way out of a deficit issue. Because think about it, is if we grow the economy, that means more tax revenue. And so that's really the silver lining for me, is that I do think there's now been a shine a light on what's happening in a lot of the states, and just overspending and misuse of funds. And so getting that out of the system, or at least bringing that back a little bit, and then growing our way out of it. But this is an issue that not many politicians are focused on, because it's hard to get elected when you're talking about cutting back on programs. But I think as Americans, we do need to be extremely concerned here. And the crazy thing about these numbers is, I started in the business in 1997, and back then it was, the debt issue was a problem. I remember even reading about it in books, basically economic books, when I was in college, that the debt was eventually going to be a problem. Well, now we're here 30 years later, and it still hasn't really manifested itself. But it is something that I think for the future health of our country, that this will have to get resolved. But it's definitely one of the top headlines of why there's, continue to be concerns out there. Tariffs. Okay, tariffs is an interesting one. Uh, I, I think the reason why this is a cause for concern is that it just elevates the amount of uncertainty. If you're a business owner that imports goods and there is not really well-defined rules, how do you make long-term decisions? So my tariff conversation has more to do with just the uncertainty of what's going to happen. When we get in and look at the history of tariffs, so this goes back, I don't have many charts that go back this far, but this goes back to 1900, which is a very far left. And then right in the middle is like the 50s. And then you can see all the way up till now. So tariffs were a part of the way we gathered revenue historically. And that essentially, you can see there was the drawdown on tariffs, and then we saw the spike during the Great Depression, and then it came down lower through World War II, and then it became a pretty small percentage on our, basically on the U.S. goods that we import. And you can see on the far right-hand side, we had a massive spike. In April of 25, it got as high as 30%. At least it was threatened to be as high as 30%. And then by the end of the year, it dropped down to about 15%. And so the thing that I don't like about tariffs is the uncertainty. The part that I do like is the reciprocal tariffs. I do think there's a level of fairness to reinstate, to help us emphasize U.S. manufacturing, making cars here, making, healthcare related items, drugs, pharmaceuticals, things that Americans need. I think during COVID, we did get exposed because there's a lot of goods that we don't make here. And when the world shut down, that put us at a big risk. So I like the idea of putting in reciprocal tariffs to make it fair. I think this is a longer debate on how things are being approached, but I just think overall the uncertainty is a negative. I am hopeful that there will be a positive impact on this, because I do believe my preference would be collecting this revenue to pay down debt, maybe reduce income taxes on the middle class and lower income wage earners. And so that would be the goal. So we'll see how this unfolds. Because I don't have clarity, I can't provide even any more details, but that's just my general take on things. So hopefully that's helpful. All right, the case for optimism. So what can go right? Earnings acceleration. So what we're looking at on the left-hand side shows S&P 500 EPS growth, which is earnings per share. And then as we work our way through this chart, you can see that, historically we have an average over this 20 plus year period where we saw the earnings per share growth is around 7%, and that is what drives long-term returns in the markets. And if you look at what's projected for 25, 26, and 27, that the earnings per share is double digits. So we're looking on this chart. So it's 11% and then 15%, 15%. So the reality is, if this occurs and we get this earnings acceleration, which I do believe will happen because of a few things. We had the tax cuts that occurred last year, which helped to unlock a lot of benefits for corporate America, which will drive jobs and drive growth, and drive earnings more specifically for companies. And then also with the advancements of AI, I think we're going to see a massive productivity boom in the U.S. In the U.S. economy. And then on our right-hand side, you can see profit margins are really healthy. So that's one big case for optimism, is seeing this earnings acceleration that's coming because of where we are in the economic cycle and what's coming because of adoption of artificial intelligence in the workplace. Inflation is cooling. This has been a bit, I mean, I read the Wall Street Journal every day, and inflation continues to come up as a major concern of people. It's a little bit perplexing to me. I think the media is scaring us into inflation's a problem, inflation's a problem, inflation's a problem. The data would not suggest that. Prices are coming down, and that's happening on the energy space. There's a lot of areas that's coming down. Food is still a little bit more complicated, but pricing is coming down, and that's a good thing. We're starting to get more normalized in like the 3% range. The Fed is targeting in the more in the twos. But I do think we're going to see a continued drop in inflation, mainly because what's happening with technology is massively deflationary, and especially with our energy policy and with solar panels and things that are producing a lot more clean, low cost energy. I think that's going to be a trend that we're going to see that will come to fruition here over the next 5 years. So I do think that. I feel like I'm getting from the journal and from others that inflation's a problem. I'm not seeing that data, and I do think this is going to continue to come down, and that's going to be a bright spot for the economy. Healthy consumer. So we all know that the lion's share of wealth is concentrated in the top 10% of Americans. We know that. The reality is, though, that also, well, in addition to that, we have to look at the data that shows how healthy the consumer balance sheet is when we look at assets versus liabilities. You saw in an earlier chart how bad the federal budget was and the federal balance sheet, but look at the consumer balance sheet. We have essentially 200 trillion of assets and about 20 trillion in liabilities. That's extremely healthy for the growth of our nation. We're also having an aging baby boomer population, which over time, there's going to be a massive transfer of wealth to the next generation as well. Household debt service is an important metric. This is on the top right. Basically just shows debt payments as a percentage of disposable personal income. It's trending higher since COVID. However, it's still below a lot of historical numbers, so we're still confident that that's a good sign. The bottom right does show a little bit of concern. We're seeing some early delinquencies that are occurring in student loans, credit cards, auto loans, things of that nature. So that'll be a number we have to keep an eye on. So, it's not getting to a historically high level, but it was at extremely low levels, and it's starting to trend higher. But the consumer right now is extremely healthy, especially in aggregate when we look at the consumer. The power of compounding. So this is a metric that we should always be excited about. It should always drive our case for optimism. And what we're looking at here is the green represents large company stocks going back to 1996. It shows small company stocks going back until same time frame, 1996. It shows corporate bonds, and it shows cash. So what's the takeaway here? This is adjusted for inflation, and it shows you that, let's just take the bottom line, which is cash, right? So if you invested in cash in 1996, that same cash position is actually worth $9,798. So you actually eroded your purchasing power over that 40-year period. 30 plus year period. So that's a little bit of a warning, because we see a lot of clients, prospective clients, and then the economic data shows us a lot of people are sitting on cash, T-bills, money markets, and we do think that we've been getting that off the sideline this past year. which proved to be a good timing. That needs to continue to happen because cash is great for emergencies. It's great for future purchases. It's great for planned short-term expenses. It's not great as an investment because you can see here over a 30-year period, basically you break even on an inflation adjusted basis. Then it shows you the power of compounding in stocks and bonds, but primarily in stocks. So compounding is the case for optimism, but again, I can say that every time because that is really the power of investing. Diversification certainty. So one of the things that I have constant conversations with clients around is around risk. And you think about like risk, and when we talk about risk, we're really just talking about potential loss of money. And you have loss of money, which means that they go down. And the chart before actually represents the opportunity cost, right? So you could be in a cash position or corporate bond, and your returns aren't that great relative to if you're a long-term investor in stocks. And so when you look at what risk really looks like, it needs to be, yes, volatility to the downside, but it's also opportunity cost. What are you giving up if you're overly diversified? Now, with that being said, this is designed to show you that when you have time on your side, the dark gray is an all stock portfolio, and the green represents a 60-40. So 60 in stocks, 40 in bonds. How does that then play out? And going through this scenario, I know I have 1 day, 1 week. So 1 day is kind of fun, right? So how does the market do? At 53%, you're going to be positive, 47%, you're going to be negative. Well, so when you think about day-to-day decision making is like gambling, it's a 50-50 chance, you just never know. As you start looking and adding time to this equation, and you go out to 1 year, 3 year, 5 years, 10 years, the probability of success goes up tremendously. This is about a 35, 36-year period. And on the far right, it shows you that an all stock portfolio that 93% of the time you have positive returns over a 10-year period, and on a 60-40, 100% of the time. Now we know past performance is not indicative of future results, but hopefully these trends are promising around why, again, diversification is important and why having discipline and faith in your strategy are critically important to that. All right, so we are going to jump into this topic around AI. I can't tell you how many headlines, where there are articles that I read in the journal, Barron, podcasts that I've listened to. This conversation around AI is in a bubble. And that is not going to go away, that conversation. So if you're asking me that question, is AI on a bubble? My short answer would be, I don't believe it is. And I still think we're in the early phase of the AI, artificial intelligence revolution in terms of the build out of the infrastructure and the adoption by companies. The second part of that, like, natural follow-up would be my answer of not yet, meaning eventually these amazing growth periods in our country's history tend to end in some level of bubble or speculation. That's just human nature. So I don't think we're there, and I don't know when we're going to get there, but it's certainly something that should be it should be on our horizon. It's certainly part of our rebalancing and diversification strategy. But I do think the short-term fears are overblown. Now, while I said that, or while I'm saying that, it doesn't mean there might not be a lot of short-term volatility. The question becomes: is it just a a bump in the road, or is it representative of any sort of significant downturn in the markets? And I would say that any sort of short-term volatility, in our opinion, would be a bump in the road, a buying opportunity, and an opportunity to accumulate some really great companies at discounted prices if we get any volatility. But let's jump into the data. So you've heard this term, you have this hyperscaler investment. So the AI hyperscalers are just the big companies you would know: Alphabet, Amazon, Meta, Microsoft, and Oracle. And it just shows you, this chart on the left shows you in billions the amount of capital that's getting spent. So in 2024, that number was 241 billion. That was in 24. 25, it almost doubled to 400 billion. We don't have the final data points yet. And then by 2026 and 2027, we're estimating those numbers are going to be north of $500 billion spend. So that's all of this capital going into the marketplace, into the US economy to build out this infrastructure. one of the reasons why I think people are so optimistic about these companies is, they're spending a ton of money. They're also driving really good revenue. If you look at the right-hand side and you look at cash flow, and you look at the light blue shows operating cash flow, money coming in, but then you look at capital expenditures, which is the green, which shows you how much they're having to spend to keep up with the demand. And then look at the impact on free cash flow. Free cash flow is plummeting because of this investment. And so this is my case for, while I don't feel like we are in a bubble, I do think that we're going to see a broadening out of returns. Most of the returns of the markets in the last 10 years have been concentrated in these big names. And we think this next cycle is going to really be a broadening out, because this is a good chart to explain why, is because free cash flow is dropping because of the cash intensity that this investment is taking. And then we start getting into, okay, well, our business is actually using AI for any sort of business function. And you can see just as of December 2025, percentage of the firms that reported, 17%, we look across all industries, are using this. That number is going to ramp up quickly. If you look at the top right-hand side, companies spending on AI models, platforms, and tools. And so the gray line shows, and this goes back to September 23, because we don't need to go back beyond that. This was what percentage of companies had paid subscriptions. So back in 23, the number was less than 20%. And now, as of November 2025, it's north of 45%. And that number is going to likely continue to trend higher. So we're starting to see more implementation and adoption, which is driving nice cash flow to the Mag 7. But we think that the productivity enhancements, and that's going to be felt downstream to a lot of these great companies, great American companies that we invest in. All right, here's as we go into, there's a lot on here as we go into looking at the Magnificent Seven and looking at these names. So just to remind you, the Magnificent Seven is represented by NVIDIA, Meta, which is Facebook, Tesla, Amazon, Alphabet, which is Google, Microsoft, and Apple. Those are the Mag 7. And if you look at 2023, you can see the price performance of these companies. The S&P had about a 25% return. The Mag 7 just crushed them. All these names were significantly higher. If you look at the far right-hand side, look at 2025. Google and Alphabet was definitely the standout. NVIDIA had a decent year, but the rest of the names actually underperformed the broad markets. So 2 of the 7 outperformed. 5 of the 7 did not outperform. And so we think that's probably going to show up more over the next several years. So while we do like these names, owning these names is almost impossible. Most large mutual funds, ETFs, will have exposure to this. The question is, do we want to be overexposed? And the short answer is no. Again, coming back to a common theme I've been saying is have discipline. We need to be diversified, and we do that through portfolio management, through discipline rebalancing. And if we look at, as we go through and look at why is there so much, I guess, interest in the Mag 7? It's because returns have been phenomenal. If you look at the top left, it just shows the returns. Over this roughly 4-year or 5-year period, the returns have just been tremendous. And it's this outperformed the U.S. markets. But again, we think that trend is going to start to shift. And we think that's going to start showing up, or we think it started to show up last year, and we think that trend is going to continue. When I saw this chart, now this was a chart put together by JP Morgan, a lot of these other slides are from our JP Morgan partner. They do something called the Guide to the Markets, and they put together this slide, which I love. It's a little hard to read at this size, but essentially what we're looking at is what were the 10 largest companies at the beginning of the year, looking at these periods of time. So the far left is 1985. Then we look at 95, 2005, 2015, and 2025. Now, if you look at 2025, it's just the names that we discussed, and we're adding Broadcom, Berkshire Hathaway, and JP Morgan. When we then look back, and this is really trying to make the case of market leadership does not last forever. And while we love so many of these companies and they're a big part of the portfolio, leadership tends to shift. If you look back in the last 10-year period on this list, Apple is there, Microsoft is there, Berkshire is there, and JP Morgan. Those are all like the same names. There's no Tesla, there's no Meta, there's no Google, there's no Amazon. Those didn't even make the list. And that was only 10 years ago. If we go 10 years prior to that, look at the names on this list: IBM, AIG, Johnson & Johnson, B of A, Pfizer, Walmart, Citigroup, Microsoft, Exxon, and GE. Microsoft is the only one today that was on that list. So if the case that I've been making around the importance of diversification, if it didn't grab you earlier, this one really should, because it shows you that leadership has changed. And at the time, these were the great companies of America, and that list has changed so much. And that's the beauty of our markets. We have great American companies that sell amazing products and continue to grow profits and grow their earnings. And that's obviously why we're investors in these great companies. So it's just a healthy reminder that leadership changes over time. And when we look at this 10 years from now, there's going to be some new names on here. And we have to prepare for that. And that's why we just don't want to concentrate all of our names in these current winners today. Whoa, that was so. As we wrap, there has been this theme in our conversation today about diversification, discipline, and this theme around rewarding investor discipline. So by making sure that you have a set strategy, you have a long-term outlook, and by building your financial plan around that, that's how we think you can reward investor discipline, because it by having a plan and believing in long-term returns in the markets, it increases your confidence, and when your confidence is higher, it allows for that discipline. So, and when I say rewarding, you get rewarded because of the power of compounding in the markets. So as we wrap, just what I highlight is what we're focused on at Vance Wealth. Number one, helping investors stay disciplined through uncertainty. Number two, ensuring portfolios remain diversified and aligned with long-term goals. Number three, making thoughtful adjustments when needed without reacting emotionally. And in markets like these, our role is simple: provide clear, informed guidance so investors can make confident decisions. And if you want to continue this conversation, if today's discussion raised questions about how this applies to your own situation, we're always happy to talk. If you would like to schedule a book an appointment with us, you can scan this QR code, or you can go to vancewealth.com/book an appointment. Just so that you know, for any prospective clients that have listened to this, our initial conversations are complimentary, and we'd love the opportunity to see if we can help you and your family. So I hope you enjoyed this. I know we covered a lot of content, but again, this is one of my favorite topics of the year. And I would love to hear from you if you have some feedback on how we can continue to make this, we can continue to improve this and add value to you. So happy New Year 2026, and looking forward to an amazing year. Thanks.